I'm Professor Green, and today we'll be talking about Chapter 13, Shareholder Rights and Corporate Governance. The case study that this chapter talks about is the Wynn case, right? Wynn Resorts. So Mr. Wynn, he became very famous and very rich by having a handful of casinos in Las Vegas, in Massachusetts, and 75% of his casinos are on the island of Macau. And a couple years ago, right, he got into a scandal so that he was accused of some sexual misconduct. And why his case became particularly interesting and why it's relevant to this chapter is because he was the first CEO of a publicly held company that was accused of sexual misconduct, right? That before him, we had Harry Weinstein of the Weinstein Company. He was accused of sexual misconduct, but he was a private owner. We also had individual contributors, such as the gymnastics coach, etc. But now when we talk about someone who is the CEO of a publicly held company, then we get into what are the shareholder rights? What is the corporate governance that gets involved when somebody at the head of a company does something that the shareholders might not necessarily agree with. And so we'll get further into this case in class, but just some key points about this case was that that the shares dropped right after the sexual misconduct came out. So now the shareholders are upset because something that the CEO did affects their personal value, their personal income. And something else to consider as we go through this case and we talk about in this chapter is executive compensation. That he was, in 2016, his annual compensation was $28.2 million, which obviously is very, very high, especially in comparison to all the workers that he employed at all these different casinos. But his justification was that even though his compensation was high, there was still 19% ROI, return on investment, for his shareholders. So he justified it that he was still giving back to his shareholders even though he still had a very high compensation. And some other things to consider when this whole sexual misconduct thing came out was that he was going through divorce and his ex-wife was leading the charge against those charges and leading the shareholders in what they thought were their rights for seeing some justice. And he was also involved with the Republican National Convention at that time. And that was a big hot topic as well for a lot of Republicans that were being called out on different things. So let's go ahead and get into the chapter, and then we'll come back to this case in class and dissect how this is a good example of what happens when we talk about shareholders' rights and corporate governance. So let's talk about the key learning objectives. Here, the first one is identifying different kinds of shareholders and understanding their objectives and their legal rights. So again, in that Wynn case, right, if you had a share in the Wynn company, what would be your right as a shareholder? Learning objective number 2, knowing how corporations are governed and explaining the role of the board of directors and protecting the interest of investors and other stakeholders, right? So you have not only the CEO and the people who work typically full-time for the organization, but you have this whole board of directors. Who are those people and what do they do? What is their role? We're going to talk about number 3, analyzing the function of executive compensation and debating if top managers are paid too much. As I just mentioned, with that $28 million annual salary, was that justified? Number 4, learning objective is evaluating various ways stockholders can promote their economic and social objectives. So you as a stockholder have rights. And number 5, the last one here, is understanding how the government protects against stock market abuses such as fraudulent accounting and insider trading, which we've spoken about as well already this semester. So we'll circle back to that and how it affects you as a shareholder. So who are shareholders, right? What is a shareholder? A shareholder is the legal owner of a business corporation, also called stockholders or investors. And there are 2 major types of shareholders these days. The first one are individual shareholders. That's like you and me if we hold stocks. These are people who directly own the shares of stocks issued by companies. And the second one that has become more and more popular in recent years are institutional shareholders, or institutional investors. And so these are examples like pension funds, mutual funds, insurance companies, and university endowments. One of the biggest institutional shareholders is the California State Teachers Retirement System, right? So any teacher in the state of California who works for a public elementary school, high school, university, community college, their retirement fund, goes into it gets managed by these institutional investors. And this is one of the biggest groups in the world, actually. They manage almost $2 billion worth of investment. So as you can see, now this California State Teachers Retirement System, they have a lot of power, right? They can say what it is that they want when they not only choose stocks, but what they potentially want the company to do. And one example was that a couple years ago, they asked Apple to step in because they were investing in the Apple products, in the Apple shares. They were asking Apple to help students because those were their clients. These were the teachers of those students, and they wanted Apple to help with when it came to child depression and sleep deprivation, right? They wanted tools on the Apple products to help parents curb children's use of the Apple products, right? So now you can see where the investors are getting involved in day-to-day activities of organizations. So a lot of this chapter will focus on that. Let's hop into the next slide. This is the stock market capitalization, which is otherwise known as the total value of stocks as a percentage of GDP. So which countries, this chart is saying which countries are heavily involved in the stock market. And this is just a select number of countries. It's not the top 10, it's not the top 5, whatever it might be. It's just a handful of countries to compare. As you can see, the United States is heavily involved in the stock market, right? We're the Wild West. We are really interested in being independent investors but we're also obviously involved in institutional investing. But the United States, as an American culture, we like to invest in the stock market. China as well, they've taken upon themselves to really get involved in stock markets around the world, Korea, Japan. But as you go down, you'll see countries such as Russia, Indonesia, not so heavily invested in the markets. Russia, potentially that's limited because it's a communist country and their government probably curtails that. Indonesia, maybe they don't have the education around that. Their culture is not centered around that. But here in the United States, we are heavily involved in the markets. And so many of you will become, if you're not already, shareholders yourself. Let's go ahead and talk about shareholder trends. This slide here talks about the first bullet point being in 2016, institutions accounted for about 60% of the value of all U.S. stocks, worth over $23 million. So back to this idea that institutional investors are just a huge part of the stock markets, even more these days than shareholder investors, as we'll see in the next slide. Let's talk about these last 3 bullet points before we hop into slide 6. In 2017, slightly over half of all U.S. households own stocks, so either directly or indirectly through holdings such as mutual funds. So if you hold a mutual fund, that means it's a group of stocks. That is, the idea is to balance out your investments. So half of all U.S. households own stocks. So that means most likely you or your parents own stocks. The third bullet point here is twice as many older working age adults, 50 to 64, own stocks than young adults under 30. So right now, the book says that 62% of older working age adults own stocks, but only 31% of adults under 30 own stocks. So that means that you personally might not own a stock, but your parent or your grandparent most likely does. And then the last bullet point here is that equity ownership is higher as income and education rises. So again, because now you're soon to be college educated, that means that, again, most likely you will be holding stock. That people who graduate just from elementary school or just from high school, they won't necessarily be owning stock. And the same thing when we talk about income. People with higher incomes will have more discretionary income and be able to feel that they can risk that money in the stock market. Let's talk about the next slide here. So this is what I was just talking about, how household versus institutional ownership has shifted in the United States. You can see in the 1960s, right, when my parents were starting to invest in the stock market, that it was really households that were investing individually, and institutional investing was small. But as time has gone on, these pension funds, these retirement funds, they have felt that they have a lot of power, they have a lot of money, and so they wanted to get in on the stock market. And as you can see now in 2016, it has shifted that institutional investing is much bigger than household investing. So many of you will actually potentially go on to work for an institutional investor, especially if you're a finance major, that you might be interested in helping these institutions manage the stocks that they have underneath their portfolio. Let's move into the next slide. These are the objectives of stocks ownership. So why do you want to own stocks, right? So the idea here is that to produce a greater return over the long run, other than investments such as bonds or cash. So just as I said in the 1960s, right, when the idea of owning stocks was going up, my parents decided that instead of putting that money in a savings bank, it was better to be in the stock market because it was going to, over the long term, it was going to earn more money than plain interest in a savings account. So it says here, shareholders make money, A, when the price of stock rises, capital appreciation, and also when they receive a share of the company's earnings, capital dividends. And so there are two, I guess, main strategies for how you make money. So just watching the stock increase in value, or actually getting an immediate payout of that increase in value. And so if you go into wealth management, right, this will be your bread and butter. You'll really start to understand what your clients are trying to get out of the stock market, and then be able to create a mix. For example, I personally feel like I'm decently young, right, at 46 years old. So for most of the stocks that I own, I hold a capital appreciation because I don't need that cash right now. I'm earning money, right? My husband earns money, so we don't need to depend on income from our stocks. But my parents, on the other hand, who have stopped working, they're retired, they receive Social Security, but obviously Social Security is not enough to live on a regular basis, so they have a lot of capital dividends coming in. They have money coming in that is coming from these particular stocks that give out capital dividends, and they are putting that into their checking account every month to live on. It's possible that I personally might have a stock that has dividends, but if I have dividends coming in, I invested that back into the stock market. And yeah, in general, the strategy for me personally is that I don't really choose stocks that give out dividends because that's not my primary interest at this stage. I'm looking to appreciate my stocks so that when I do retire, I'll have a bigger bucket. The last bullet point here is that bull markets alternate with bear markets, right? So what is a bull market and what is a bear market, right? A bull market means that there are a lot of gains for investors, so that the stock market's going up, 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 up. And that's why at the front of the New York Stock Exchange, if you ever go there to Wall Street, there's a big statue of a huge bull, right? Because the stock exchange is all about making money for people. They want to be making gains for investors. But bear markets have a place as well, right? The bear markets happen during recession periods. Bear markets is when the stock market is creeping back or maybe just slowly going up, and this is a great opportunity for people maybe to buy stocks at a lower price. And when we have a bull market and where do you have a bear market, right? As you learn in your economics classes and your finance classes, right, there's a handful of different dependencies on where the market is. So they alternate mostly on the health of the economy, right, whether in a growth economy or a recession economy. Also, it can be controlled by interest rates, right? That's why you see so often the Fed really playing with those interest rates. Right now, the interest rates are very, very low because we're in COVID times, so they really want to make sure that the markets continue to grow. But if there's too much inflation or if the if the market's get out of control, then they will increase the interest rate because that then, well, this is more of an economics discussion, but the growth in interest rates, right, will bring in more of a bear market because there'll be less investment in the world. And another way that the bear and bull markets can move is through world events, right? So when September 11th happened, we moved very, very quickly into a bear market for a couple of months, or for, I'd say, a year or two, right, where this is somewhat of a recession period, that people were hesitant to invest because we didn't really know where the next terrorist attack was going to be, if and when it was going to happen. So super interesting ideas here. Let's move on to the next slide before I get too excited about that previous slide. Let's talk now about the objectives of stock ownership. Again, why would we like to invest in the stock market? So here, that we talk about stocks because they have historically produced a higher return over the long run than bonds or CODs or money markets. So in this chapter, we're not necessarily talking about bonds or CODs or money markets. We're talking simply about stocks. And shareholders are not a uniform group, right? So I was talking about my investment versus my parents' investment, right? Some they seek long-term appreciation, and some seek short-term gains. So those are two different strategies. And then another strategy is where some seek capital gains and some seek dividend income, right? I was just talking about, right? I personally like the capital gains, but my parents like that dividend income. And so there's again, shareholders are not a uniform group. And as I said, if you go into wealth management, you will learn this forwards and backwards. Some investments use stock ownership also to achieve social or ethical objectives. And we're going to talk about this further under an area called social investment in this chapter. But I just wanted to bring that up here because that is a big part of this course, because we do talk a lot about ethics, obviously, and sustainability. And so when you're a shareholder, these ideas can be mixed as well, right? As I said, I have mostly stocks that have capital gains, but I might have a stock or two in there that has some dividend income if I feel that stock really has a lot of potential, or if my financial manager feels just like it's a really good opportunity, or if it's at a good price to buy the stock, whatever it might be. So before we hop into the next slide, because this slide doesn't necessarily mention owners or shareholders, they might buy a stock to also take control of a company, which we'll talk about as well in this chapter. Let's move on to the next slide now. So there are some now major legal rights of shareholders. So now that you've become a shareholder, what are your rights? The first one is to receive dividends if they are declared. You also have the right to vote on things. You can vote on members of the board of directors. We're going to talk about the board of directors in just a moment. You can also vote on major mergers and acquisitions, right? So if the company is going to merge with another organization or be acquired by another organization, you can vote if you want that to happen or not. You can vote on charter and bylaw changes. You can also vote on proposals by other stockholders. And typically it's one share has one vote. So people who have more shares obviously would have more voting power. The third legal right of shareholders here is to receive annual reports on the company's financial condition. So now they've recently just gone paperless, but growing up, you might have seen huge amounts of big envelopes arriving to your house if your parents were invested in the stock market, because all of these organizations are required to send out these reports to all of their shareholders. The fourth major right is to bring shareholder suits against the company and officers. So this is where we get back to that WIN case. So the shareholders of the WIN organization started to sue the company and their officers because they felt that they weren't necessarily doing the right thing when that sexual harassment case came up against the owner. And we're going to talk about that further in class, as I mentioned. The fifth and final major legal right of shareholders is to sell their own shares of stocks to others. So if you would like to sell your stocks, you are welcome to do that. And at the moment, the reality is that actually more institutional investors vote. Like the 91% of all institutional investors, they actually vote, but only 29% of the individual investors vote. And I have to say, I personally am part of that, the rest of that 29%, 71%. I'm part of that 71%, even though I own a handful of stocks. I don't often exercise my right to vote, only because I just feel like I don't have a lot of information on what the issues are. I kind of lean on my financial manager to make sure that having an investment in that company is the right thing to do. But actually, for voting on a regular basis, I don't. And that is really the trend, because basically you see that only 29% of individual investors vote, probably for that reason, because maybe they have so many shares they can't keep up, they don't feel educated on the ideas, etc. And again, we'll talk more about that in this chapter. But the idea here, what I really want to bring home, was that the institutional investors have a lot of power, support, and bandwidth to really take care of the investments that they have in their portfolios. Okay, let's go ahead and hop into the next slide. Let's go ahead and talk about corporate governance. So corporate governance is just like country governance, right? So we have President Biden, we have a government, same idea, but now for organizations. What is the president or CEO of a company? What is their role, and how does this work, and how does this affect the shareholders? So corporate governance refers to the process by which a company is controlled and or governed, right? A big part of corporate governance is the board of directors. And so the board of directors is an elected, we're going to get to this, an elective, I'm going to put that in bunny ears because it's not necessarily a true election, of a group of individuals who have a legal duty to establish corporate objectives, develop broad policies, and select top-level personnel to carry out these objectives and policies. So this role of the board of directors is growing in recent years. Again, when I was in business school or when I was a child, this board of directors wasn't very influential. It was sometimes a voluntary thing. But in recent years, a lot of my friends, now that I'm 20 years out of school, have become members of board of directors. And it's no longer a voluntary thing, but they get paid to sit on these boards and direct the organization. Very often these boards meet about 6 times a year. So, right, once every 2 months, they often will go on a couple-day retreat to talk about the growth and direction of the organization. And there's been, as I said, a growing emphasis on the day-to-day operations of organizations from the board of directors. They focus on strategy, the talent management, as well as investor relations. And this can all be found on page 287 of your textbook if you're following along in your text. So let's hop into the next slide and get further into the board of directors. I found this section really interesting, as I said, because this role is growing in recent years, and you, even as your first year out of college, will start to engage, or at least hear very often, what the board of directors is doing and what they're saying. As I said, personally, I have a lot of friends now that are being asked to join these board of directors now that we're 20, 30 years out of school. So board of directors, they vary in size, composition, structure, and they serve the best interest, ideally, of the corporation and of the shareholders. There's a survey of corporate governance practices in leading firms in the Americas, Europe, and Asia Pacific. Typically, the board size is between 9 and 11 members. And most are outside directors, not managers of the company, who are known as inside directors. And we'll talk about the difference here in this chapter as well. The survey that was done with this information was done by the Society for Corporate Governance. And again, I'd like to mention all these different societies that get mentioned in your textbooks or in our outside references, because They are a stakeholder, right? And at the beginning of this course, chapter 1, we talked a lot about engaging with your stakeholders. So again, if you get involved with your board of directors or are more interested in what the board of directors do, you might want to look up and see what the Society for Corporate Governance does. Another key fact, before I go on to the next slide about the board of directors, is that the New York Stock Exchange now requires a majority to be outside directors. And again, we'll continue to talk about this idea, but the New York Stock Exchange has seen that it's better when the board of directors comes from outside of the organization to get an outside perspective, that there's diversity, there's ideas that get contributed. So it's not just people talking within the organization and talking about maybe the same things all the time, or having this jump on the bandwagon type of idea. But if we have board of directors that are outside of the company, then we have a broader perspective and we have a better guided organization. And where these members can come from. So if you're an entrepreneur and you have a company, where are you going to find your board of directors, right? These are chief executives of other companies. These are major shareholders, right? So if you have a shareholder that has a large portion of shares in your organization, they might have something to say about your organization and they would like to be included in the board of directors. These can be bankers, right, because they have a lot of background information as to how the stock market works, how companies work. These can be former government officials, because again, right, all organizations, we need to work as well with government organizations. So if you have someone on your board who has been involved in the government, such as the SEC or working with Sarbanes-Oxley, a handful of different roles that engage with organizations and the government, that could be useful. Maybe someone who is in academia, like me, right? I have an MBA. I really, in theory, I know a lot about business, a lot about organizations, a lot about theory, especially organizational behavior theory. So maybe they might hire a professor to be part of the board of directors. These can also be representatives from the community, right? Because again, you want to get lots of different stakeholders involved. This can be someone who, if you have a company that works in a particular area, like I have a friend, he is the CEO of Tender Greens from the restaurant. So he might have, because that's very LA based, he might have someone who is involved in Los Angeles to be a part of the board of directors of his organization. And then you might also have retired executives, because this is a really great job, an opportunity for executives who no longer want to work full-time, but have some part-time opportunities. So they can come in 6 times a year and meet with your organization. And at the same time, they have a lot of experience, right? Because they've worked for 30 or 40 years in the corporate world. So that's who the board of directors are. Let's move on to the next slide. Board of directors are elected by shareholders at the annual meeting, where absent owners vote by proxy. That's me. I hardly ever go. I've never gone, actually, to any of my shareholder meetings. So if I do vote, occasionally, I will vote by proxy. Process is not truly democratic. So this is why I was talking about with those bunny ears, right? That board membership tends to be self-perpetuating. There are 3 major bullet points here that talk about that the board nominating committee works with the CEO and chairman, develops a list of candidates, right? So it's not just outside people applying with their own unique perspectives. It's the CEO and chairman, and they create the people who they would like to sit on their board. And after they've created this list, the names of these individuals are placed on the proxy ballot, and alternate candidates are really rarely presented. That's just the way it goes at this moment. But honestly, I expect this to change, right? Especially with everything that we've been seeing in the past couple of years, Black Lives Matter, COVID, et cetera, that people are really having the social media, having more of a voice and speaking up. I expect that more shareholders will take it upon themselves to get involved in the organizations with which they're investing. So that will start to change. And if you do become a member of a board, it's a good thing. I don't think I've mentioned already, but these board members, they usually get around $300,000 a year in in pay, in income. This is a combination typically of cash and stocks. And so, so for meeting 6 times a year, that's a really nice salary. But at the same time, because they get money and or stocks, is this a conflict of interest, right? That sometimes people who sit on the board of directors, they don't necessarily want to jeopardize their pay by challenging ideas, right? They don't want to say, that's a really silly idea, because then the CEO or the other members might say, well, then you can leave if you don't like that idea, and then they lose their pay. So, right, there's a fine balance as to how these board of directors come together, who gets paid, who they are, etc. And so, like my friend who's the CEO of Tender Greens, he really thought for a long time as to who he wanted on his board of directors because A, he was going to be taking leadership advice from them, but B, he was going to be paying them to give them him leadership advice. And so he wanted somebody who he thought would be fair, would be engaged, would be knowledgeable about the issues that were coming up with Tender Greens, and especially as they went to go sell their company in the last 2 years. Before we hop on to the next slide, the principles of good governance, I just want to mention that there are typically 5 major committees on the board of directors. So, right, so you have a board of directors of, 9 to 11 different people, and then each person on the board of directors will sit on 2 or 3 different committees. And there are 5 major committees, which should sound familiar to you after studying 4 years of business and definitely 1 semester of business ethics. We have a compensation committee. So these people on this committee, they monitor what the top level executives are being compensated to make sure that that's in alignment with what the New York Stock Exchange or different organizations such as the U.S. government might promote and recommend for compensation. We have a nominating committee. This is like a search committee for again, top-level executives within the organization or on the board. We have an executive committee, and they talk about major issues that are coming up in the company. So if you're talking about Tender Greens, they were really focused on the last couple of years on the selling of Tender Greens to became Union Restaurants in New York City. We have a CSR committee on most board of directors. So there's a handful of 2 or 3 people on the board of directors that focus only on CSR, which is really exciting to see that area grow. They want to make sure that they are engaged in the community and there's sustainability happening within the organization. And then the last one, which for some of you is very exciting, audit. Right? So we want to make sure that the people who sit on the audit committee are financially literate because what they're doing is they're looking over the financial statements of the organization and making sure that those financial statements are correct, are clear, and will pass a true auditing organization, right? So that there's no funny business when we talk about accounting, a really important part of being on the auditing committee. Let's go ahead and talk about principles of good governance. We have this slide and another slide, and then we'll finish with part 1 of this chapter, and then there'll be a second video when we talk about part 2. So principles of good governance. This is on page 289, if you're following along in your textbook. There are 5 major principles. The first one being we want to select outside directors to fill most of the positions, right? So I've mentioned that a handful of times already. The New York Stock Exchange recommends it or requires it for all organizations listed on the New York Stock Exchange. Lots of other organizations recommend it because it's so vital to get these outside perspectives. Another major good principle of good governance is to hold open elections for members of the board, right? So that's not necessarily a rule, but that is a good idea so that you have open elections so that all the shareholders can come in and vote on who's going to sit on that board. Hold elections for all directors annually, so that sometimes directors can have a tenure or a term of 2 or 3 years even. But when you have good governance, you give the opportunity for directors to be voted in annually so that if other people want to run or if people think that director is not doing a good job, then they can be voted out. You want to appoint an independent lead director, right? So again, somebody who is outside of the organization who can lead these board of directors who's a little less biased or less, just has that outside perspective as to what's going on within the organization. And again, you want to diversify board members, right? And so that's why I think the textbook said that now up to, I think, 20% of board members are held by women. This has become a really big role for a lot of my colleagues, female colleagues, to sit on the boards of different organizations because they really want to get different perspectives. And another trend, I think, that I briefly mentioned is that shareholders have recently demanded the right to nominate their own candidates. So it's not just the CEO or top-level management that nominate candidates, but shareholders have gotten involved in nominating their own candidates. And often what we see now as a trend is that board members will often step down if they're running unopposed, but they still don't get the majority vote, right? So again, it's really important to have now multiple people running for one position on a board. The last slide before we head into Chapter 2 talks about corporate governance worldwide, and this is really going to talk about the United States versus Europe when we talk about corporate governance. So the first bullet point here is the OECD. That's the Organization for Economic Cooperation and Development, a really big and powerful organization if you've never heard of it before. It represents 34 nations. It's issued a set of principles of corporate governance to serve as a benchmark for companies and policymakers worldwide. So again, if you get involved in your board of directors, you definitely want to be familiar with this organization and what it is that they're doing. One of the big things here is that the European Union, they say here, has worked hard to modernize corporate governance practices and harmonize them across its member states. So in the past, board of directors in Europe were, I don't want to say stodgy old men, but that was kind of the idea. Maybe it was just the CEO and his friends, 2 or 3 people that were the board of directors. But because unions and laborers have become more and more powerful in Europe, especially in France, that the EU has decided that they really need to modernize and make this model more up to date. And so actually European boards now have a 2-tier system. So if you go to work for BMW or Siemens, any of these European organizations, they have not just one board, but 2. And the first board is the executive board, which is like our board of directors. That's the CEO and some insiders who are involved in the organization. But then they also have what they call a supervisory board. And these are more outsiders, and these include labor representatives. So these would be the head of the unions, people who actually are doing the work inside factories, inside BMW, for example. And they have become much more powerful in recent years, these supervisory boards, because as we speak about in this course, right, the laborers are a shareholder. Not a shareholder. They are they are partake in the daily operations of the organization, right? And so, of course, the executive and the supervisory boards, they coordinate their work, but together they feel like they have a better representation of the interests and of the organization and then together they can make better decisions for where the organization is going. Okay, great. So that ends part 1.